All right. Today is Sunday, August 27. This is a recap for the stock market activities last week and an outlook for the week to come. Now, folks, I got a good one for you tonight. And folks, the week that was, it was all about what do you believe? Really? Will NVDA really buy $25 billion worth of shares right now? Is former President Trump really 215 pounds? Did the market really go down? And the answer is yes, it went down. If you look at the monthly performance for the market, we're down. At least for now, absent of a miracle this week. We're going to close the month down. And just a few weeks ago, a lot of, especially the pussy bears, they would say, oh, the market will never go down from this point on. It's up, 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 up. And of course, when they start talking like this, you got to scratch your head and say, okay, we're going down. And of course, in the week of what do you believe? Well, can you believe that Peloton and AMC are down about 97% apiece from the 2021 tops? What happened to the mother of all short squeezes? Maybe now that's a reference to her butthole. And can you believe that the 2023 IPO market is already crashing? We just began here with Kava. Here's the latest one. It's called Better Stock. And it crashed upon opening by 90%. Nothing to see here, of course. And can you believe that Palantir executives are pieces of shit who could care less about the company? And every time the stock pops higher, they're dumping with both hands. They keep pumping. Oh, Palantir is the Messi of AI. Well, if it's messy, it's already dead now because they're dumping it right away. But folks, we have to talk about something important here. Such as this comment from the viewer says, 2 months and we're leaving San Diego just like you, Maverick. I could talk for hours about all that's wrong about California now, but I still miss it. I've spent over 30 years in the Golden State. It's been good to me. Shame what it has become. Amen, my friend. It's the same thing. It kind of reminds me with a conversation that I had today with an Uber driver. And I'm in Vegas now, so he also moved to Vegas from LA. And I said I moved here from San Diego. And it's not because of the taxes. I've been paying 50% for years. But when crime escalates in your neighborhood from, my catalytic converter got stolen, to my Amazon package is gone and it's on camera and the cops can't do anything about it, to witnessing somebody walking her bulldog and then a car pulls over and 2 guys come out and they steal the bulldog. Broad daylight. Somebody gets robbed and beaten right in front of your home and nothing happens. No biggie. It's just another day. And of course, the next step is somebody's going to get killed here. So I better get the hell out of here. But again, me and this driver were reminiscing about California and what we're going to miss, what he misses already. And of course, he talked about the ocean, the breeze, how green it is, Disneyland, all of that stuff. I said what I miss is human feces on the sidewalk, the toxic ocean water, endless traffic, the beautiful sight of homeless people all over the place, that kind of stuff. But then somehow the conversation evolved into Beyonce, because Beyonce's in town. And he goes, if you look at a decent ticket, it costs about a month's salary. How the hell are folks affording all of this? And for what? To sit on the top of the stadium and see Beyonce as a dot? Where's the money coming from? Because it seems everything goes higher, the prices keep going higher, but somehow people are just holding and they keep spending nonstop. And I showed him this. I said, look, it's all credit cards. They're swiping those credit cards up and down, up and down, up and down, with no consideration at all to what happens of, oh, did I just lose my job? We now have over $1 trillion in credit card debt in this country. And to illustrate that for you, it's about 8.5 times one of those Ukrainian packages. So you know it's big, and we just keep spending nonstop. Now, when we look at folks with credit card debt for over a year, it's about 72%. Not from those who are earning $50,000 or less. No. Those who are earning $100,000 or more. Those are the ones, 72%, holding credit card debt for over a year now, 27%, holding credit card debt for over 5 years. And these numbers keep going higher. So we know that consumers are just using these credit cards to cope with the increase in the cost of living. And why are folks using credit card debt? Believe it or not, the majority say because of an emergency expense. Because, we have a flawless and absolutely brilliant healthcare system where it is a choice. Do you want to get better? But there is a chance you might get bankrupt too. So it's up to you. But look at the vacation/entertainment responses. Those earning over $100,000 or more, 22% say that they're using credit card debt to pay for a vacation or entertainment. So the share of consumption in the economy by credit card debt is growing higher and higher and higher by the day as consumers run out of savings. And perhaps this is also important to consider. The Wall Street Journal says that it's a woman's economy. Women own this summer. The economy proves it. The top performing movie is Barbie. The top event of the year is the Taylor Swift tour. So women are now driving consumption in the economy and inflation. And of course, for years, women been fighting about equality. We got to have an equal shot. We got to join the workforce. We have to earn our own money, independence, yada, yada, yada. Well, ladies, welcome to corporate slavery. You want it? You got it. More moms at this point participating in the labor force than any point in recent memory. And those wages are moving higher and higher and higher. Of course, the downside is you got to deal with your asshole bosses and supervisors who are not really doing the job. They're not really interested in doing it right. They just want to scam the government or the consumer, your co-workers, conniving backstabbers. And you got to deal with all of that. And if you're lucky, you get to buy a home when you're 53. Enjoy. But anyhow, back to the conversation with the Uber driver. I explained all of this to him, that we have credit card usage, we have more women spending now. And this is why you see all of these tours, whether be it Beyonce or Taylor Swift, and people paying thousands of dollars to sit at the top of the stadium and see Taylor Swift as a dot. What is the point here? Now listen, I'm as Swifty as it comes, but I don't understand this shit. I'd wait for her to get older, go back to her country roots, because that's what I really enjoyed. I don't want to see Taylor Swift shaking her little booty and lip syncing for $13,000 a pop, but to each his own. But see, the thing that I admire about Taylor Swift is A, she's a money-making machine. B, she's a gangster. She's gonna milk those dumb Swifties for every penny. Oh, here's the same album, it's just another color. Oh, here's the 1989 version of the same album. What's next? The 1987 version of the album? How about the 1987 version of the stock market? Because that's more interesting. And I know what you're going to say, Maverick, you're obsessed with 1987. It's all over the place now. It never happened. That's just perma-bear talk. Okay, let's just get the facts here. Isn't it interesting that the market topped at this headline? It reads, Wall Street closes down. Dow snaps the longest winning streak since 1987. I'm not the only one saying it. The parallels are all over the place. What are we talking about here? We're talking about when the market and bond yields go higher together, especially the 10. So this is where we add here in 23. When bond yields go higher, A, we see the premium risk for the stock market deteriorating. Because what is the point of holding the stock market when we have bond yields going higher? Risk-free. Number 2, we see that valuations matter when bond yields are going higher. So usually we see when bond yields go higher, stocks go down. But in the event when we see bond yields and stocks moving higher together, one of the two is usually lying. And more times than not, the stock market is the one lying, which means there is an abrupt adjustment that will happen to stocks. So right now what we see here in the aftermath of the rescue of Silicon Valley Bank, bond yields and the stock market, the SPX in white, bond yields in orange, going higher together. We have seen this phenomenon before and it doesn't end pretty good for the stock market. Example, 2018. As we head into 18, we have the tax cuts optimism. We see bond yields and the market going higher together. And then what happens? We get volume getting and the stock market crashes. Then a few months later, as Jerome Powell starts to increase interest rates, we see bond yields in orange moving higher. But so did equities. And then what happened? We got a crash by the end of the year. The stock market went down almost 30%. And why did that happen? What was the trigger point for the stock market to crash? Let's add more lines here. Again, orange, that's bond yields, the 10-year yield. Notice that the moment the 10-year made a new high, the stock market crashed, be it in volume getting or later in the year. The moment bond yields made a new high, stock market topped and went down. Crashing, not just went down amicably. Now here's another example. In 2013, the taper tantrum, we saw bond yields and the stock market moving higher together. But in this example, bond yields were lying because the Fed did not really taper. There was no taper at the end. But most importantly, look at the chart here. As bond yields went back to the highs, the stock market looked really shaky. But those highs were never challenged. It was a double top in bond yields and they went down after that and the stock market kept going higher. So this is really important to keep in mind. We go back to 87 now. Again, bond yields in orange, stock market in white, the SPX. And as you can see, both of them going higher together. Until what? Until we saw bond yields in the 10-year moving higher and taking over the previous high. That was the moment when the stock market topped and started crashing. So we go back to 23. We have already taken the highs the previous highs in the 10-year yield, and the stock market went down immediately. We got a rebound on Friday, but do you now understand the importance of who's lying here? Is it the stock market or the bond market? And you know where my stance is. Last weekend, the title was, "No, I'm not wrong. The market is." And the bond market is saying that. I'm not wrong. The stock market is. And if we keep going higher in bond yields, we could be seeing an 87 crash, a volume getting crash. So when I bring that up, I'm not just being sensational. I'm actually following history and warning you of what's going to happen. So keep that in mind. And I'm not the only one, by the way, talking about such a crash. When we look at the U.S. Crash Confidence Index, institutional investors and individuals now catching up are starting to believe and expect a crash, be it a volume getting like crash or an 87 like crash. And when we look at the percentage of investors who think there's a greater than 10% probability of a crash in the subsequent 6 months, we're now looking at about 75% of all investors. We're now thinking perhaps a crash is coming. And we're not talking 5 years from now. We're talking within the next 6 months. The headline reads, "Fears of a stock market crash among investors are the highest since the start of the pandemic. Yale Gauge shows." What are they talking about? Listen to this. 44% of institutional investors believe a similar crash is at least 10% likely over the next 6 months. And this is just a notch below the 51 reading back when SVB collapsed. The U.S. Confidence Index, an index that gauges investors' belief that the stock market has more than a 10% chance of experiencing an 87-style stock crash, here it is the highest it's been since the early months of the pandemic, when the S&P 500 crashed around 30% over the course of a few weeks. And no, this is not just happening because, we have this YouTuber doing a financial show from his garage called The Maverick of Wall Street fear-mongering. Investors, all in all, are now believing the same. It's not just me. A persistent number of bearish investors in Wall Street have remained worried about the odds of a recession and a sharp sell-off in stocks, despite inflation cooling and the U.S. economy remaining resilient due to credit card debt. Oh, they're not going to add that. I'm sorry. That is because the Fed could keep interest rates higher for longer than markets are expecting, which raises the risk that central bankers will push the economy into a downturn. Higher rates could cut into the economy's strength, especially when considering lagged impact of the Fed's rate hikes, which kicked off in March 2022. The labor market has already begun to slow its robust growth over the past year, and Americans are now beginning to exhaust their excess savings, which has been a major buffer for the economy since the pandemic. The New York Fed has forecasted a 66% chance the economy will tip into a recession by July 2024, and JP Morgan warns that stocks could go down by 15% at least, even in the event of a mild recession. So where do we go from here? If all eyes are going to be on the bond market, is it going to go down and cool off and we all have a sigh of relief? Or is it going to continue to go higher? We see the stock market crashing and fear invading the economy all of a sudden. And to answer this question, we have to go back to Jackson Hole. Why Jackson Hole, Maverick? Because the number one question we all must ask, is the Federal Reserve really in charge now? In other words, has the Federal Reserve lost control over the bond market? Because it seems that they want to talk it down. Hey, 10-year. Hey, 30. Stop going higher. We're just going to be data dependent now. We're just going to wait and see. With no formula, with no forecast, with nothing at all. We're just going to dance on the tune of inflation. So will you stop going higher, Mr. Bond Market? And we're talking about the yields, not the price here. And of course, the response by the bond market is a big, fat middle finger right in the face of Jerome Powell. The bond market says, I'm going higher. And now, not only you lost the battle against inflation, and you have to catch up again. You lost the battle against the bond market. Now you have to catch up with me, because I'm going higher, which means you got to start raising rates. And you know why I'm going higher? A, because you're a weak pussy. B, we have the deluge from the Treasury Department. We have a rebound in inflation. Energy prices are moving higher again. And we have the Bank of Japan. We have China. We have Saudi. We have many other countries dumping bonds. We have you, the Federal Reserve, dumping bonds. So I'm going to go higher. And you try to catch me if you can, Mr. Powell. And therefore, the headline reads, Fed Chairman Powell said the central bank remains unsure of whether more interest rate hikes are needed. Oh, you're unsure? And you're the Fed Chairman? So if you don't know, then we're all fucked here. You don't have a plan. You don't have at least, a target, a goal. You're just going to wait for whatever inflation tells you and then You follow after? If inflation goes higher, you're going to start to hike again? Oh yeah, that's exactly what he's going to do. Fed Chairman Powell calls inflation too high and warns that we are prepared to raise rates further. So this is not exactly Mr. Payne. This one is even more dangerous and should scare you more because this is Mr. I don't know. I have no clue at all. At least Mr. Payne had a plan. On the other hand, Mr. I don't know, he's just going to wait for the disaster to happen and then react to that. So now we see the dollar moving higher, although it cooled off in the session. This is why equities rebounded on Friday. But the dollar finished higher all in all. And if it appears that the dollar is going to continue to go higher, equities will go down again. And this is the way of the dollar and bond yields to say to the Federal Reserve that we're going higher. You got to catch up now. You're wrong, Mr. Powell. You can't wait. Inflation is going to rebound. It is rebounding. The base impacts are not here. Base effects are not here. Oh, you're going to raise in September. And that's the problem with the Fed here. The ambiguity, the lack of certainty, and the market doesn't like uncertainty. The market loves a Fed chairman with a clear path, even if it is Mr. Payne. Mr. Payne had a clear path. The market did. It went down, the bear market rally went kaput, but it held on pretty good and then made a bottom in October. But with Mr. I don't know, you don't have any certainty here. You don't have any path. So the market could be more volatile this time around. And the problem with Mr. I don't know, formerly known as Mr. Payne, he could have finished the job by now when in 21, all of these categories were hot. Jerome Powell could have made a shock and awe decision by increasing rates by 300 basis points. One shot. And this would have produced fear in the economy. And all of these categories cooled down together. But his so-called data-dependent approach, 25, then I'm going to catch up and do 50, then I'm going to catch up again, do 75, and then inflation cools off, and I go down to 50, then 25, then pause, then inflation comes back, and I go up to 25, 50, 70. You see where this is going? This is not going to go great, folks. And now the economy is split between the hot and the icy. And if you add that kind of pressure by going aggressive to take inflation down, you're going to break something in the economy and cause a credit/a systemic risk event. And as bond yields continue to go higher and higher and higher, we get closer and closer and closer to that scenario. Look at the pressure and the stress that the U.S. government is facing right now with interest rates moving higher. The interest payment as a percentage of the revenue is reaching 20%. Now, you look at the broader economy, you look at the stock market, and you have all of these companies heavily in debt, and they have to either refinance or pay more in interest payments. Now you're adding a lot of stress into the system, and something is going to break up here, and it's going to be contagious. And you can say that Jerome Powell was dovish or hawkish and whatever zoo animals you want to pick. At the end of the day, they're not in charge, and if inflation is going to rebound, and we know that from wages. Wages continue to go higher. We now have the UAW auto strike. Thousands and thousands of employees. What do they want? They want higher pay. What are the autos going to do right now? They have to pay it. There is no other choice. And that wage inflation is going to feed into the economy, producing more and more inflation. And therefore, you got the Cleveland Fed president, she sees another rate hike. And she says that rate cuts may have to wait. And I would say if the economy is really resilient and we have a soft landing, then why bother to cut rates at all? The economy can handle it. This is why we got the soft landing. You're only going to cut if a disaster happens. And a disaster will happen as rates continue to go higher and higher and higher. But despite all of this, from Powell, from from many of them, the media goes on and says, despite what Powell says, the Fed is likely done. Why? You know better than the Fed now? This is your propaganda media. And the market is fighting the Fed too. You gotta understand that the Fed is not in charge. Inflation is. And inflation is moving higher. So the Fed will have to react. You can't say that the Fed is done. The Fed will only be done if a disaster happens. And a disaster will happen. And again, you might have heard it a lot in the last few weeks, especially on Friday, the word transitory. CNBC all day long, transitory. Even Jerome Powell suggested that this could be transitory. And this is absolute insanity because we know it's not transitory. It's now embedded in the economy. And Larry Summers has been warning all week that we could be on the same path as the 1970s. Inflation goes down for a little bit. The Fed declares mission accomplished prematurely, and we see inflation moving higher again. So we go back to 87. What will stop the rise in bond yields? Because if they continue to go higher, at some point the market is going to crash, and this point is becoming really near, as the 10-year makes a new high, for example. The only thing that would stop bond yields from going higher is either the resumption of quantitative easing when the Fed starts to buy bonds, but because of inflation, the Fed lost that kind of control over the bond market. And the other scenario is if something blows up, and by that time it's too late. The stock market already crashed. This is why we bring up 87. And this is why you gotta understand that at the end of the day, the Fed will keep fighting inflation. They have no other choice until something breaks. And by the time something breaks, it's going to be too late. Too late for what, Maverick? Too late to get out of the stock market. Too late for, I don't know, preparing for the crisis. Because you've been racking all of this credit card debt in Taylor Swift and Beyonce and all of the bullshit that's going on in the economy right now. And you lost your job suddenly. And sure, rates might go down, but you got all of this debt that you have to pay right now. And you have no source of income. But I know what you're going to say. You're going to say, but Maverick, all of this doesn't matter. You know why? Because it's AI. AI will fix it all. Just look at NVDA. Look at what happened in NVDA. You said they're not going to deliver. They delivered and then some. They keep taking orders more than McDonald's. And I say, suppose all of that is true. Suppose that the numbers that NVIDIA is given are not cooked and they're not just orders that could be canceled at any time. That this is not really a transitory bump in demand and pricing because of special circumstances called a bubble. Let's just assume that we believe everything that NVIDIA said. Why such a negative reaction to, I would say, pristine report? Not only they're beaten the revenue guidance, they got it even higher. So why is the stock down? It wasn't down as folks anticipated, that a crash, it would go down 20-30%. But it was also surprising that after a massive guidance, yet again by NVIDIA, the stock reacts by flattish in the first day, then it goes down the next day. Well, Mike Wilson from Morgan Stanley says that the reaction by NVIDIA stock is actually a signal that the stock market rally is over. Markets top on good news and they bottom on bad news, Wilson said in an interview with Bloomberg Radio. And you know what? He's right. You know what the headline was right before Cisco topped in 2000? Well, here it is. Cisco briefly tops Microsoft as world's most valuable firm. And this is March 24th, 2000. A few days right before the crash. Well, isn't that interesting? I can't think of any better news than what we got from the company, Wilson said, referring to NVIDIA. The failed boost is another negative technical signal that the rally is exhausted, and now we're going to need a new story to get people excited, and I don't know what that story is. The Thing? Could it be the comeback of The Thing, if I'm using my tinfoil hat? But anyways, here's another headline that reads, the last NVIDIA bear on Wall Street throws in the towel and ditches the sell rating. Isn't that the kind of headline we get on tops? And by the way, whatever NVIDIA says, 15 billion, 16 billion, 20 billion, 25 billion, the stock is pricing all of that in. And then some. Now factor in what I pitched for you, which is these are all orders. They haven't been really manufactured. The manufacturer, Taiwan Semi, didn't see any increase in demand or any increase in orders, which means that if the economy sours or the AI mania starts to dissipate, we could see a lot of these companies saying, hey, NVIDIA, I don't know about that order. Can we pull out? Because we got a lot of problems right now and we can't really afford $40,000 a pop for these chips. I think we're overpaid. And the resolution by NVIDIA is, well, how about you keep your orders and we take the price down? In either case, as I said before, this is as good as it's going to get for the stock. And here's the headline, NVIDIA's AI-fueled profit beat has investors cheering. But a deeper analysis shows serious valuation problems. Here's another one. Not everyone is hyping NVIDIA's earnings. Here's why. One analyst says the chip maker is ridiculously overvalued. What is he talking about? A reasonable projection what NVIDIA must accomplish to be worth the current $1.19 trillion, let alone the average $1.5 trillion the Wall Street crowd positing, suggests that its shares are anything but a good buy. More likely, they are substantially overpriced. And this is according to David Traynor, the chief of research firm New Constructs. He developed a reverse discounted cash flow model to project how fast its margins, we're talking about NVIDIA here, and sales must grow over the next 25 years to justify the current valuation. The bogeys are high indeed. Hiking after-tax profit margins from 29.5% based on the trailing 4 quarters to 44% and raising revenues at an annualized pace of 20%. NVIDIA's valuation is ridiculous. People should not be chasing this stock before it drops by around 80% to below $100 a share. In other words, this is expensive trash. And all what we're seeing right now, because a reminder, these chips came out last year, but there was no increase in sales, there was no mania, there was no hype. This year, we got the hype, and all of a sudden demand surges higher, and the pricing power explodes higher. Meanwhile, the competitors, They did not really expect the hype to happen. NVIDIA has the advantage of being a little early, but their products, we're talking about AMD and Amazon and the rest of them, their products will show up in the market soon, and they will undercut NVIDIA's pricing. So again, this is as good as it's gonna get. The stock is really, as this author says, or this analyst says, is ridiculously overvalued. It's an opportunity of a lifetime to cash out knowing these facts, that the pump in the stock price is not really justified, and there is a huge reckoning coming. Now folks, to wrap it up, we talked about the bond market in the intro of this video. We talked about how the bond market is your lead, that if it goes higher, then we're going to get closer and closer to the scenario of a market crash. But since we're talking about the bond market, is there a bullish scenario? And the answer to that is yes, there is a bullish scenario that the bears must be aware of. We talk about that in the charts analysis, so don't miss it here, don't skip. But before we do that, let's talk about the market information for you, and we begin with the closing of the indices last Friday. And here we go. The Dow Industrial Average closing positive by 247.48 points, or a gain of 0.73%. The Nasdaq also closing positive by 126.67 points, or a gain of 0.94%. The S&P in the green by 29.40 points, or a gain of 0.67%. We look at the sectors on Friday, all positive, led by cyclicals. At number 2, energy, and number 3, technology. It's actually a tie between energy and technology. Then comes industrials and utilities. So you see that there's no theme here at all. Energy goes higher with technology, with utilities. So that tells you that we have an algorithmic bounce, aka an oversold bounce, and that's all there is. But maybe we have a theme here when we look at the weekly performances. What do we see here? On top, number 1, cyclicals, number 2, technology, number 3, communication services, and the laggards at the bottom, energy and defensive. So what is the theme for the week? The answer is offensive. Long cyclicals, although there are certain names that tilted the performance here, but technology, communication services, and that tells us that we had a risk-on kind of a rally, if you want to call it that, for the week. What is the reason? The answer is, how about bond yields cooling off a little bit in the longer end? I'll tell you why this is important in the charts analysis, so stick around. Look at the breadth. The NYSE 60% advancing versus 37% declining. The Nasdaq 50% advancing versus 46% declining. So we're almost at the neutral line here. Of course, when we look at the 52-week lows versus highs, more lows than highs, and I would say overwhelmingly on the Nasdaq side at least. So now the market has the permission to pop higher or go down because we parked neutral by the end of the week. So it can go either way from this point on. But the guide will be A, bond yields once again, and the dollar. And we have nothing on the economic calendar on Monday. So we're going to be all eyes on the dollar and yields. If they start to go higher, more likely than not, the algos are going to start to sell the stock market. And how about commodities? Here's the closing on Friday. The dollar went higher by a little bit. It moved down throughout the session, and I think this is why we've seen stocks, and maybe in this case commodities, rebounding and moving higher. Specifically when we look at WTI, Brent, they were actually down at some point during the day, but then rebounded and closed positive. So this could be a leading sign that the dip is over in crude and higher we go from this point here. The RBOB was up about 3% on Friday, and look at this heating oil, aka diesel, was up about 5% on Friday alone. So when they talk about inflation being transitory, if the cost of fuel for trucking and moving all of these goods across the country goes higher, then we will see prices going higher across the board. Everything that gets delivered will move higher in price, just to compensate for the increase in diesel cost. And I think this goes with the warning from Larry Summers that we could see a rebound in inflation. I believe that we are already seeing it happen. And that, by the way, could happen hand in hand with economic weakness, such as a soft jobs number. And then we're going to start talking about stagflation. You look at softs, we have moves higher by sugar, OJ, cotton, and cocoa, while we see lumber down about 2.5%, and then coffee down about 1.5%. Now, keep an eye on lumber here because it was the leading indicator when we looked at the charts side by side. We have a correlation between lumber and the Nasdaq, the Qs, and usually lumber is the leading indicator. And as lumber started to go down, a few days later, we see the stock market going down. And then we saw a big rebound in lumber, and now it's fading away. And we have seen a big rebound in the stock market this week. So are we about to head down again as lumber suggests? Keep that in mind. Now, looking at the weekly performances for these commodities, we can see that the majority closed higher, some by a lot, such as oats futures up about 8.5% for the week. Silver up about 7% for the week. Sugar, heating oil, we talked about that. Cotton, copper, coffee, gold, all higher. What went down this week is lumber, which is not a good leading indicator. And then you have wheat down about 3%, lean hogs, palladium, soybean oil, but the majority of commodities were higher this week. And that's important to keep in mind when we talk about transitory inflation or the Fed is done with the job. We move on to the options market, aka the big casino. What do we see here? The volume went higher by a little bit on Friday, but that also came with more buying of puts. And if you remember, we talked about how puts are gonna top for a little bit, and we see a rebound in calls, and then we see puts catching up again. And I believe this is happening right now. We see more buying of puts. What does that say? It says that market participants, at least here in the options market, don't really believe these rebounds. They believe that we're gonna go down, so they start to buy more puts. And of course, as that materializes and we start to see the charts putting in new lows, we see more and more puts getting bought. At some point, it becomes excessive and we get a bottom, a legitimate one. Let's say a tradable one at least. Moving on to the unusual activities that took place in the options market on Friday, and we begin with the ticker AMC. Of course, this is the side of a tragedy because, it's making new lows now. And we were told that we have to stick it to the man, and we have the mother of all short squeezes, and you're a boomer bro. What's up with the doom and gloom? And now it's ending badly. It's heartbreaking, but we warned, they did not listen. So what can we do here? But here somebody sees a big move coming. They're just not sure, is it going to be up or down? They believe it could be 20% or so, and this is actually a good spot for this kind of move. AMC goes down by 20% if we have a bankruptcy filing, for example. AMC pops by 20% or more if we have somebody buying the company, if we have a refinancing deal. So here we have somebody who sees a major move coming. They're not sure it's going to be up or down, so they're buying both calls and puts with about a 20% target. They bought the 15 calls, they bought the $10 puts, all for the expiration date September 1st, meaning this upcoming Friday. Paid about 40 cents a piece for the 15 calls, paid about 30 cents a piece for the 10 puts. All in all, the entry cost is about 70 cents a piece, and they spent about $1 million on those. Then we have the ticker SAVE, which is Spirit Airlines. We haven't talked about this name for a long time now, but somebody sees a pop coming here, and they bought the 17.5 calls for the expiration date November 17th, with expectations that the name could go higher and gain more than 13% by then. Paid about $1 a piece to enter this trade, all in all spending about $600,000. Then we look at NVDA NVIDIA. Here we have somebody bidding on a rebound. Perhaps we go back to the highs and maybe surpass the highs. How would that happen? We need a lot of buying here. And I believe if NVIDIA is going to rebound and we see more money being poured into the AI mania, then the benefactor would be AMD, not NVIDIA, as folks look at the opportunity. If there's this massive pool of money coming NVIDIA's way, well, NVIDIA is overvalued right now, but at least AMD will be able to chip away some of these orders, perhaps billions of dollars if they manage to undercut NVIDIA's prices and offer perhaps a similar quality. Then we're going to see orders rerouting from NVIDIA to AMD. And I would think AMD is the largest benefactor, but somebody's going to bid on NVIDIA here regardless, and they bought the 520 calls for the expiration date September 8th, with the expectations that NVIDIA will go higher and gain more than 13% by then. They paid about $1 and 60 cents a piece to enter this trade, all in all spending about $800,000. And then we move on to the heat map. What do we see here? This is the heat map on Friday. Rebound across the board, inclusive rebound. And of course, more money being poured into Tesla, for example. A lot of folks believe that this was the bottom, and higher we go from here. We'll look at the chart in a minute. And of course, more buying around the AI mania. We see NVIDIA down again, about 2.5%. Some profit taking happening in NVIDIA. And the money's going in Oracle instead, in Adobe, in ServiceNow, other AI names. And of course, we see rebounds in industrials, in Boeing, for example. We see energy rebounding. Look at VLO. Valero was the top performer in energy. We see even Staples rebounding. So it was an inclusive rebound, and it tells us that the algorithms played a huge role here. Yet when we contrast this with the weekly heat map, what do we see? Almost similar. Tesla is the outperformer. We talked about how oversold the name was last week, and we had a call options trade on it, and that produced gains north of 1,000%. And then, of course, the other outperformer for the week was NVIDIA. It gained into the report, and then comes the report, and we have buy the rumor, sell the news, and we see NVIDIA going down. It was an eventful week for J&J Healthcare, down about 3.5%. This is supposed to be a stable name, a blue chip kind of company, but We have seen a lot of volatility in the options market, and the result is here. And perhaps we see concerning signs in retail. You look at Nike, that's down about 6% for the week. You look at Target, that's down about 7% for the week. Then you look at Dollar General and Dollar Tree and many other retailers. They're all down big. Ulta was down big. And before that, it was Macy's, then Nordstrom, then Dick's, Foot Locker. All of these retail businesses are crashing right now. And this is really concerning. But perhaps even more concerning is the weekly performances for banks. You got Wells Fargo down about 3%. You got Bank of America down about 2%. And as yields go higher, the risk of that systemic risk against banks become more likely. We look at the weekly heat map for the ETFs. What do we see here? Again, we go back to the same conversation. You look at the XRT, down about 4% for the week. So retail, really weak. We look at banks. The XLF was okay. It was flattish. But then you look at the KRE, which is perhaps the leading indicator here. We see the KRE down about 2.5%. And then we talked about the dollar perhaps stalling and yields going down a little bit and how good that's going to be for gold miners. You see the GDX up about 3.5% for the week. You look at silver, did even better, up about 6.5% for the week. On the other hand, energy was the loser. And the reason is energy tracks yields more than the dollar. So the dollar cooled, and this was good for gold miners to rebound. But then when yields cooled down, it pulled back energy, the XLE, XOP, OIH down with it. And of course, when the dollar goes down, it's not just going to be gold miners and the SLV outperforming. It's going to be Chinese equities, the FXI. It's going to be Brazilian equities, the EWZ. It's going to be emerging markets such as the EEM. All of these were up for the week. But the theme, once again, is clear. The majority of the gains in the stock market this week happened before NVDA's earnings, and they were concentrated in technology and chips. So we see the XLK, the SMH leading the pack. We see that large cap growth outperformed this week. Value down, mid cap down, small caps down. And then the question becomes, okay, if NVIDIA maybe put in the top and the reaction is really negative after a blowout earnings, then you got the oversold rebounds in the large caps such as Apple and Microsoft. Okay, what if that's done now? Should we see large cap growth going down again? Well, to answer that, we have to look at the charts, and we begin with the SPY, the S&P 500. This is an hourly chart. What do we see here? We got a rebound on Friday because the dollar started to go down. It made a top and then started to move down, but it appears that the dollar is rebounding. We'll talk about that in a minute, but it was good enough for a rebound on Friday. But the rebound got us back to the highs of the day at around 441.20. We stopped there. It's not a negative closing per se because it was at the highs, but why did the market stop at a prior high during the day? This opens the risk of perhaps this is becoming a head and shoulder formation. And down we go from here. We got an oversold bounce, and then what? Are we going to go down again? And the answer to this question is 438. You lose 438 again, then we're going to go down more. 438 is intact, then we can rebound all we want. But it is a steep hill to climb. We have to close above 443 to say, okay, we're maybe out of the woods here. We look at the daily chart for the E-mini futures. What do we see here? We closed above the support. That's the good news for the bulls. The other good news for the bulls, number one, the RSI perhaps firming up here. So is the MACD, and then we have perhaps a higher low. The bad news for the bulls and good news for the bears is that it appears that the resistance at 4,472 is intact and strong. It was tested twice and the market failed to move above it, but we're still above support, so nothing has been broken here, all in all within range. And now you know the numbers. If we break below 4,384.5, then down we go to 4,300. If we break above 4,472, then we can say, okay, the correction is over, and back we go to the highs. We look at the SPX, the cash index daily chart. What do we see here? We're using the Bollinger Bands, the 20 MA in white and then the 50 MA in blue. What we know for now is we got a rebound forming a higher low. That's the good news. The bad news is we got a rejection this week, a big one, an engulfing candle from the 50/the 20 MA. That's bad news number one. Bad news number two. The moving averages are crossing now. It would be a miracle if we see the 20 rebounding higher again from here. The more likely scenario than not is the 20 crossing below the 50, and that's going to trigger the algos to sell. And this will be a confirmation that we have a bearish trend now. And if it takes us down, we can go down to 4,300 or the 100 MA, which comes a little above 4,300. Now we'll look at the weekly chart. What do we see here? Using the Bollinger Bands once again, we have a negative divergence in the RSI. We have a confirmation in the MACD indicator that we have bearish momentum, but we are still above the 20 moving average in the weekly chart. So the bulls are still alive here. You lose the 20 MA on the weekly chart, then we're going to go down big. And we are now at a critical point because this is the retest. It's happening right now. And a reminder, since the crash of SVB and the rescue by the Fed, we have not seen a revisit to the 20 MA. So we have no idea when we talk about the durability of the rally. We have no idea how this is going to hold. Is it going to hold strong and produce a rebound? For example, if we go back to the bull rally beginning in 2020 and ending in 22, we can see multiple retests. This is still a weekly chart. We have multiple retests at the 20 MA, and they're all successful. We see bounces, and the stock market keeps going higher. And we haven't seen that kind of test at least since the collapse of SVB. So when we talk once again about the durability, the test is coming. And if the market fails, we got a problem here. Then we'll look at the monthly chart. What do we see? Is this a top here and down we go from this point, a lower high? The key to answering this question is the monthly closing. And we have a few days left here. If we have a closing below the open of last month's candle, and that would be a confirmation of a top. And we've seen that happening before in 22. So all eyes on the monthly closing. It's going to be really important. Is it going to be above the low? Not the low, excuse me. The open of last month's candle or below? If it is above, the hope is still alive. If we close below, then we have a top. Then we'll look at the Qs, 30 minutes chart for the NASDAQ. What do we see here? Once again, as Powell came out and spit whatever he spit out of his hole, a Jackson hole, we see equities going down as the dollar moves higher. Then the dollar starts to move down, it cools off, and we see a relief bounce in equities, including the NASDAQ. The problem is, it doesn't erase the possibility of a lower high. It doesn't erase the possibility of a head and shoulder topping pattern. That could be a rebound, and then down we go. And the key is 361.40. If the chart goes down below this number again, then we have a confirmation that this is a topping head and shoulder formation. And of course, when we look at the daily chart of the continuous contract of the NASDAQ, we have a bigger problem here because we have a larger head and shoulder pattern. And for now, I don't see how this is going to be reversed at this point because we have a massive engulfing candle here. And this will be a steep hill to climb for the bulls. But the bulls are not out of hope here. And the reason is you got an improvement in the RSI. We have an improvement in the momentum indicator, the MACD indicator. And we have a higher low for now. But the problem becomes if we see the Qs, in this case the NASDAQ futures, trading below 14,675, then we got a problem. We got a confirmation that this is the topping head and shoulder. We look at the NDX, the daily chart. What do we see here? Using the Bollinger Bands, the 20 moving average in white, and the 50 in blue. What we know here is we have a massive rejection candle from a retest at the 50. A massive engulfing candle. Then we got a rebound, forming a higher low. We see the momentum indicators improving a bit. But the problem is, notice that the moment we saw the 20 MA crossing below the 50 MA, the algos reacted by producing this massive bearish engulfing candle. Now, usually this is not going to end in, the 20 recovers and goes higher again. Usually we will see a prolonged period where the 20 moving average trades below the 50 moving average. In that case, we're going to have lower lows in the NASDAQ. The problem is it going to be before or after a rebound? And for now, we have a rebound on Friday. We'll see if we have a follow-up on Monday or not. And if the answer is no, we're not going to have a follow-up and we're going to go down again, then we have to plug in the 100 MA. And in this case, it could take us down all the way to, let's say, 14,500. And then we'll see what happens. Now, we look at the weekly chart for the NDX, the NASDAQ. We know that we're not at the 20 MA. And the last test was back in the Silicon Valley collapse. So we have to do this retest. If it holds, so far so good. But if it doesn't hold, we got a problem here. Then we'll look at the monthly chart. Once you have an uptrend, the tops are marked by what? A bearish candle that closes below the opening of last month's candle. And we've seen that happening in 21. And the market went higher by a little bit, but this was a warning sign that the top is here or near. What we see right now in the closing of the month of August so far is we should have a closing below the open of last month's candle. If that is the case, then we have a confirmation that we are at the top or the top is near. We look at the IWM, the Russell 2000 hourly chart. What do we see here? Sure, we got a rebound from 182 after the bear flag played out and we saw a gap down, but we stopped at 185, no higher high here, and we actually formed a lower low. So can we see more pain to come in the IWM? Sure. And the Russell 2000 is the leading indicator in this case. We look at the daily chart and we look at the 20 versus the 50 MA, we know that we have a crossing imminent. And we know that the Russell 2000 is consolidating right now in a bear flag pattern at the 100 MA. What happens when the algos are triggered to sell once the 20 crosses below the 50? The answer is a big reaction, and we lose the 100 MA. If we do, down we go to 175.65, which is a gap fill. And that would be a downside of about 4.5%. We look at the Dixie 15 minutes chart. Here it is. We talked about this, by the way, in the live stream, that if you see, and the marking is right here from the live stream, if we see the Dixie trading below this support line, then more likely than not, we'll see the equities market rebounding. And we did see that. But here's the bad news for the equities market. If we use the hourly chart this time around, what do we see here? A possibility of an A, B, C pattern. We look at the daily chart for the dollar. What do we see here? If it wants to go higher, it can. And we have 104.7 as the next resistance, but at that point, it will become overbought. But the pop all the way to 104.7 could do what? Could produce a pullback, a big leg down in the SPX, for example, all the way down to 4,300. Then we see a more sustainable rebound in the SPX and a more sustainable top in the dollar, perhaps for a few weeks, a couple of weeks maybe. We look at gold, the old man daily chart. What do we see here? The answer is it's holding and waiting for the dollar. The dollar keeps going higher. But gold right now says, okay, I'm oversold. I'm just waiting for the dollar to pull back to finish whatever move it has. And then I have a big pop coming, a bull flag that will pop higher. Here's the problem. What if the dollar pulls back in the moment for, let's say, a few days, few weeks, then it rebounds higher to make higher highs. Then we look at the weekly chart for gold. What do we see here? A topping head and shoulder formation. And the support line has been already lost. So can we see a retracement to the support line, now resistance, failure, then gold goes down more as the dollar rebounds from its pullback? Something to keep in mind. What about silver? The SLV now consolidating in a bull flag pattern on the daily chart, which perhaps could produce a pop if the dollar indeed starts to pull back. And if we look at the weekly chart for the SLV using the Bollinger Bands and the 20 MA, we see that we have a weekly closing above the 20 moving average, which is bullish, not bearish. So for now, silver perhaps more confident that the dollar is going to pull back and perhaps stop soon than the old man gold. We look at the daily chart for UK oil, Brent. What do we see here? We got the rebound exactly where it should happen. And this is bullish, not bearish, but the confirmation will be closing above 85 from a daily chart perspective. Then the topping head and shoulder formation goes out of the window. Then we look at natural gas. What do we see here? This is the daily chart. We have a trend on the Henry Hub, a bullish trend for now, and maybe a wedgish pattern, which could produce a pop all the way to 2.67. And then we'll see how that resistance holds. We'll look at the 2-year yield. What do we see here? It is marching higher to make higher highs. And that's going to trigger some reaction in the stock market, because the 2-year would say, hey, Powell, you're going to have to do more, buddy. You're going to hike in September. And the market is not really prepared for that. Then we'll look at the 10-year yield. What do we see here? It lagged the 2-year on Friday. It failed to crack above the resistance at 4.27. For now, it maintains the pattern of higher highs and higher lows. But then you look at the RSI, we have negative divergence. You look at the MACD indicator. We have a negative crossing and a negative reading on the histogram, which indicates the support could fail, but we see the 10-year moving down. You look at the 30. It's hanging by a thread now on a steep trend line. We look at the RSI. We look at the MACD indicator from a daily chart perspective, we see that the 30 could move down even more. Now, what does that mean if the 2-year moves higher and the 10 to 30 start to move down or at least cool off? The answer is we will see re-inversion of the yield curve out of steepening. And here comes the bullish case. On the bar chart, we see the 2-year by the 10. In yellow, and I lowered the opacity a little bit here, we see the SPX, just to illustrate something for you. If the chart is moving higher, then we have an inversion in the yield curve because the 2-year gains over the 10. If we see the chart trending down, then we have steepening because the 10 gains over the 2. And if you notice the trend here, the market loves inversion because inversion kicks the can down the road. Steepening is when we start to see problems in the stock market. We've only seen this twice this year. Once during the collapse of Silicon Valley Bank, and this time when the correction began in late July. But as of Friday, what do we see? We see re-inversion of the yield curve. We see the 2 gaining over the 10 and the 30. And does that mean that this is going to be good news for the stock market, that we will see the rebound continuing into Monday or Tuesday? Until, of course, we see the yield curve re-steepening again. So that's the bullish case. that now we have re-inversion, at least let's say on Friday's closing, and that supports higher equities markets. So if you happen to be bearish in the stock market, just keep that in mind. When we talk about hedging strategy, if you're betting on the downside, but you still see the yield curve inverting again, you might want to buy some hedges, such as if you short technology, maybe you want to buy calls on the TQQQs, for example. Just keep that in mind. And of course, just to illustrate the correlation here one more time, when we saw the 2 versus the 10 consolidating in the aftermath of the collapse of SVB all the way till the end of the month of May, we have seen the equities market pretty much consolidating. So the market is following this pattern right now. Inversion good, steepening bad. And if the inversion continues, then this is going to be good for the TLT. We'll look at the weekly chart. What do we see here? We have a double bottom. We got a big rebound here. And I played it via call options, but I'm done now. Even though the target goes all the way up to 98.88. So keep that in mind. But your eyes have to be laser focused on the inversion versus steepening. And we'll look at the VIX. What do we see here? Daily chart. Another rejection candle from 17. The hour size now in negative momentum. Negative divergence, so is the MACD. So when we look at the daily chart for the VIX, what do we see here? More evidence pointing out that perhaps the rebound could continue here in the stock market. But we look at the weekly chart, what do we see here? The momentum is still positive despite the pullback. And every time we've seen the MACD pop higher, at least in the last couple of times, the pop in the VIX was last time around 79%, and the time before that it was 81%. Let's say an average about 80%. In this pop, we're up about 47% when we pulled back from that. So could it be just recharging the gun here to blast higher again? The answer is it could be. We have seen pullbacks, similar pullbacks, in the last few pops. Granted, these pullbacks came in the beginning of the bullish momentum, not at the middle of the bullish momentum as we see right now. We look at Apple, the big kahuna, an hourly chart. What do we see here? We got a rebound on Friday, but does it change anything here? The answer is not at all. We have a higher low for now, but we have a lower high. We look at the daily chart. What do we see here? Using the Bollinger Bands, the 20 MA, and the 100 MA. It appears that we got a rejection from the 20 MA. We're still trading below the 100 moving average. And at some point, the 20 will cross below the 100 moving average. The crossing below the 50 already happened, and it produced a big reaction to the downside. In other words, can we see the rebound in Apple continuing until we see the moving averages crossing again? Something to keep in mind. You look at the weekly chart for Apple, what do we see here? For now, we have a retest at the 20 MA. We can go a little higher and retest it again. But for now, the chart says that whatever retests we have, they're not going to be successful, and the buyers are going to give up buying the dip, and the sellers will show up again. We will see another leg coming for Apple. You look at the monthly chart, again, we have a minor and a major trend line. If we go down to the minor trend line, because right now, it appears, the month still has a few days left, a miracle could happen. If we close like this, and most importantly, if this month closing comes below the open of not last month candle, but the month before, the month of June, if we do that, then we have a confirmation for a top, and we're going to go down to the minor trend line, and that will be a downside from this point on of about 13%. And then if that's broken, we go down to the major trend line, and that will be a downside of about 20% from here. Then we'll look at Tesla, the souffle, an hourly chart. What do we see here? We got a rebound on Friday, but does it change anything at all? The answer is no, because we have 240. If it closed above 240, we would have said, okay, we have a confirmation that higher we go. But now we can't say anything about it at all. We have to move on to the daily chart, and let's see what it says here, because it's not all bearish, by the way. We look at the daily chart. We're above the 100 MA. We have an improvement, a positive divergence on the RSI and the MACD indicators, and we're just consolidating here below the 20 MA in what could be argued as a bull flag pattern. Once enough energy is received, we see a pop above the 20 MA, and then comes the conversation of, can we close above the 20 MA on a weekly chart perspective or not? And of course, if Tesla wants to go crazy from here, it can, believe it or not, because we have a gap fill above, and we can go all the way higher if we have another episode of the mania. But here's the problem for Tesla. If we look at the weekly chart, we're above the 20 MA right now. So Tesla survives, at least for now. If it loses the support line again, then we have a confirmation that Tesla wants to go down. And here's the monthly chart. We still have the topping head and shoulder. And even if Tesla goes all the way up to closing the gaps on the daily chart, it is not going to change this topping head and shoulder outlook unless Tesla closes above 300 from a monthly chart perspective. So keep that in mind. And last but not least, what about tulips, Bitcoin, and daily chart? What do we see here? At least at the time of the recording of this video, nothing is happening here. We have bearish consolidation, and we're waiting for buyers. The chart is oversold, and it is inviting buyers. If the buyers show up, we're going to have a closing above 26,555, and Bitcoin is going to move higher from that point on. If the buyers don't show up, then the sellers are gonna. We're going to see a big breakdown leg in Bitcoin. But for now, nothing to see here. So we're going to move on to the conclusion of this video. And what do we have on the economic calendar this week? Monday, the 28th, we don't have anything at all. So it could be a good day for the market to continue to rebound a little higher. Then we have Tuesday, the 29th, we have job openings, we have the Case-Shiller Home Index, and we have consumer confidence. Wednesday, the 30th, we have the ADP employment report, we have a revision on GDP, and then we have the trade balance, retail inventories, wholesale inventories, along with pending home sales. And then Thursday, the 31st, the last day of the month, we have initial jobless claims, then we have the PCE index, which Jerome Powell already leaked. He was not supposed to do that, but he leaked it on Friday. So we know the reading is going to be benign. And then we have the Chicago Business Barometer. Comes Friday, September 1st, and we start a new month. We have the non-farms, all eyes on the non-farms, unemployment rate, hourly wages. But we also have the ISM Manufacturing Index along with construction spending. And with that, folks, this is all I got for you for now. But a reminder, if you happen to be a member of the channel, we have charts to watch. And that's going to come before the open. We're going to look at all of these weekly charts, individual stocks, because we're getting into the heat of the seasonality. September is going to be an important month. So I'm going to set you up with these weekly charts before the open. Stay tuned for that. But folks, this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.
You need that eclair?
Yeah. Save it for later.